Okay, it's great to see all of you, and thank you so much to CIAS for inviting me down. It's always an honor and pleasure to be back here almost every year. And I'm excited to be here today to really share with you strategies on how to achieve consistent profits investing in the stock market. And I've just got half an hour, so it's a challenge for me because my normal talk is minimum about 4 hours. Okay? So I'm going to do my best to move very fast. But just to check, how many of you here have got quite a few years of experience as an investor, which means more than 5 years you've been already making money consistently over time? Show of hands. Don't be humble, please. I need to know. Come on, don't be humble. Come on. Okay. Hi, Sandy. How are you? Okay, great. How many of you have got a little bit of experience? You know, sometimes you make money, sometimes you lose money, depending on your feng shui. Okay. How many of you have got no experience? You're beginners. Oh, a lot of beginners in the crowd. Wonderful. Great. So to maximize our learning experience today, I'd like to just ask you to participate along with me. So you learn a lot more. Is that okay, everyone? Great, thank you. So as I share ideas with you, I'd like to ask questions. And when I ask questions, please raise your hands to give me your response. Yeah? Because your response is really important to me. And if I say something which is worth remembering, I may ask you to repeat what I say. So when I do that, all right, with all your energy, what's left, please repeat what I say. Thank you. Then you remember a lot better, yeah? Okay, let's get started. Now, the first question is, why should we invest? I'm sure you already know the answer to that question. But why invest in the stock market? Now, if you take a look at the long term, okay, how do the different assets grow your money over time? Now, whatever we want to do, the first thing is we have to beat what? Inflation. You know that already, right? So if you look at the long-term inflation rate of Singapore, it's about 3.2%. But we know in the last 2 years, it's actually gone up by how much? 4 to 5%, yes or no? Yeah? So even at a 3.2%, is it worrying? Okay, think about this. 20 years ago, in 1990, how much was a movie ticket? 1990, any just guess? About $354, right? Okay. How much is it today? About $10, $11, $12, right? So from $3 something to now about, $10 to $12. How many times is that? About 3 to 4 times, right? Which means logically with the same inflation rate in 20 years, okay, how much would a movie ticket cost? 3 to 4 times the price today. It will cost $30 to $40 per ticket, right? So when you become Akong, right, you bring your children to watch a movie, family of 4 will cost how much? $120 to $150 per movie. That's pretty scary. Now, think about it. 20 years ago, how much was a 4-room HDB flat in Bedok North? 20 years ago, 1990. Anyone stays around Bedok? Bought something 20 years ago? Roughly how much? It's about $100,000, right? How much is that flat today? 400,000 to 500, right? So from 100 to 400, how many times? 4 times, which means logically 20 years from now, a 4-room HDB flat will cost how much? 4 times the price today, 1.6 million for a 4-room flat. Can you afford to live in Singapore 20 years from now? Right? So can your children afford to buy a flat 20 years from now? It's a 4-room HDB flat, which means a private apartment condo will cost at least double of that, yes or no? Which means a small condo will be what? 3.2 million. Which means a small landed property, at least 5 to 7 million, right? So when people say, isn't investing risky? I tell people, not investing is even more risky. Because if you don't invest, and you put all your money in a Khon Guan biscuit tin, 20 years from now, it's going to be a lot less, right? So think about it. If you got 100,000 today, and you put in a Khon Guan biscuit tin, you don't invest, right? 20 years from now, it's going to be worth what? 1/3 or 1/4 the amount, yes or no? It's going to be worth what? About $33,000 or less. But if you invest that money, it's going to at least grow and compound to something a lot better. Now, question is, what do you invest in? Again, there are many instruments, many assets, and they perform differently at different points of time. Now, if you look at the long term, when I say long term, it means the last 30 years or more. Okay? Fixed deposits have averaged about 2% over the long term. Now it's less than 1%. Can't beat inflation, right? Gold. Has gold done pretty well? Gold has done very well in the last 15 years, right? Because of the devaluation of the dollar and because of all this uncertainty and fear. Gold has been driven up pretty high. And it has averaged about 7.6% compounded annually. If you look at bonds, about 6.4%. Property, this is based on the URA property price index. If you take it for the last 30 years to today, you do a compounded annual return, it's about 6.8%. US stocks, as measured by the Dow Jones, has returned 12.33% with dividends reinvested inside. Right? Everyone repeat so you remember. All say 12.33. You sound very excited. Okay. The Singapore stock market for the last 30 years has returned with dividends reinvested 10.15. Everybody? Thank you, right? Hong Kong market the last 30 years has returned 13.14%. And surprise, surprise, the Jakarta stock market has been the best performer in the last 30 years, beating the Indian and the Chinese stock market about 15.87%. Okay? Now, two things to understand. Number one, when we say that the Singapore market went up by 10% annually in the last 30 years, does it mean every year it goes up 10% sui? No, the market is very what? Volatile. On a bad year, the Singapore market can drop 60% in 1 year. But on a good year, it can also go up 80%. Isn't that true? So what does this refer to? The average over that period. Okay? Does it mean any stock you buy will give you this average return? No. If you buy the wrong stock of the wrong company, like Faro China, or Costco, or Raffles Education, it can drop 80% and never come back. You lose your money, right? But you buy the right stock like an APB or FNN, would that go up much higher? Yeah. So which stock does this refer to? Which stock? Which stock? It refers only to the blue chips, or we call it the index component stocks, right? How do you know what's the index? How do you don't know what's the index? How do you don't care? You're going to care. Now, the index is a small basket of the largest stocks used to represent the entire market. Okay? So, for example, in the US, how many stocks are there? A lot. More than 12,000, right? So, of the 12,000 stocks, they pick what? The 30 largest companies, right? The blue chips, right? Like your Microsoft, okay? You got your Procter & Gamble, your Coca-Cola, your McDonald's, your Pepsi-Cola, your Johnson & Johnson, your Boeing, your Alcoa. These are the 30 biggest, right? And they take the average price of the 30 biggest. What's that average price called? It's called the Dow Jones Industrials Average. Have you heard of the Dow Jones? So when you hear the Dow Jones went up by 10%, it's not all the stocks in the market. It is the 30 biggest. Okay, how about Singapore? How many stocks are there in Singapore? About 800 total, right? So of the 800, they pick what? Again, the 30 largest companies, right? UOB, OCBC, SGX, SMRT, SIA, StarHub, okay, Golden Agri, Olam. Take the average price of the 30 stocks. What do you get? Straits Times Index, or the STI, which measures the whole market. So when you see the Singapore stocks return 10%, it's not every stock. It is the average of the what? Of those 30. You with me so far? Okay, so once we understand the basics, question is, how do you make money from the markets? I'd like to pose this question to you. Seems like a very bold statement, right? Is it possible to earn a 10 to 13% annual return without picking a single stock, almost risk-free? Let's do a vote. In Singapore, voting is compulsory. Who says yes? Okay, who says no? Who say, I don't know? Now, I'm not going to tell you the answer. All right, I want you to answer this question yourself. And you tell me if it's true or not true. All right, so I'm not going to tell you. Now, first, let's take a look at history. This is the 30-year performance of the US market, represented by the Dow Jones Industrials Average. So you can see that the stock market in the short term is very what? Volatile. It's like a roller coaster. Every time it goes up, it must come down. Every time it goes down, it must go up. So from the beginning of the 1980s or even the 60s, right, it goes up, down, up, down, up, down, up, down, up, down, up, down, so on and so forth. But although it keeps going up and down, but over the long term, what happens? It keeps what? Trending higher. Over time, it makes higher highs and higher lows. So for the last 30, 40, 50 years, the index always ends up higher than before. Right? So question, 5, 10, 20, 30 years from now, will the index be higher than today? Yes or no? Yes. How you know? My question is, why can't it come down? Who says it must go up? Why must it go up? Inflation, very good. Now the answer is the index will always go up over time. Why? Number one is inflation. Think logically. Let's say out of these 30 stocks in the Dow Jones, right? Let's pick one as an example. Let's say we look at McDonald's, okay? It's one of the Dow stocks. Do you have McDonald's in Singapore? India? China? So although it's a US stock listed on the US stock exchange, they don't just sell to the US market. Who do they sell to? The entire world, right? So think logically. 10 years from now, would a Big Mac be priced higher than today? Guaranteed. So even if McDonald's doesn't sell an extra burger, but because each burger is priced higher, the sales revenue will be what? Higher in dollar terms, which means the net profit after tax will be higher in dollar terms, which means the value of the company will be higher in dollar terms, which means the price will readjust to the new value. Make sense? 10, 20 years from now, will there be more or less people in Singapore? India? China? Why? Because more people are born than people die, yes or no? And Singapore, not enough born, we import, yes or no? So over time, there'll be more and more people in the world. It's called population growth. So because there's more people, more means more. What? More demand. More people buy more Big Mac. More ice lemon tea. More French fries. So McDonald's have to just keep what? Growing more and more outlets to feed a growing population. Make sense? Reason number 3, the 30 stocks in the Dow Jones, are they always the same 30? No, they change. If one company doesn't do well anymore, what happens? Gets kicked out of the Dow, replaced by the next better player. So it's always the best 30 companies in the market. And because of these reasons, the index always goes up over time. Make sense? So first thing to understand as an investor, the index always goes up over the long term. Can we say that? The index always goes over the? Okay. So imagine in 1980 or 85 or 90, right? You bought the index and you close your eyes. And you go up and down, you don't care. Hold for the long term. And today you open your eyes. Would you make money? How much you make? You make the gradient of this line, which is equivalent to an annual compounded capital gain of 9%, plus a 3% dividend yield on average. That makes you 12.33%. Follow now. How about Singapore? Singapore is even more volatile than the US. Super roller coaster. Battlestar Galactica. So imagine you invest in a Singapore market and you got no strategy. You just whack. And let's say you're damn sway. You entered here. Let's say you entered at the top of the market cycle in 87. You know 87 crash, right? So if you entered here, what happened? Pow! Oh my God! The market dropped by how much? 50% in 1 year, right? So that's why people say stocks are risky. So is the stock market risky? Yes or no? Yes or no? Yes, if you sell there. Who asked you to sell there? If you know that the index will always go higher over time, confirmed because of population growth and inflation, what do you do there? Yeah, you hold. In fact, you got more money, double up. Double your money. Because what goes down will always go up. Index only, not stock. Index. Don't double up on Raffles Education, okay? So if you double there, guess what? Within 2 years, you make everything back plus a profit, right? Hold for 2 more years, go flat. Hold 2 more years, whoa, millionaire. If from here to here, went up how much? About 300%, right? And if you keep holding, and of course, if you don't know how to get out, and you keep holding, oh my God, walao. But I say, what goes down must come. Keep holding long term, close my eyes. You see, sure come back one. They keep holding, oh my God, go down again. Whoa, multi-millionaire. Die. Oh, millionaire again. Now we are somewhere there. Right. So, what's the point? The point is, can get heart attack, right? Can get bloody heart attack, right? But if 1980 or 1990 or 2000, you bought the index and you close your eyes, go up and down, you don't care. Hold for the long. Would you make money? How much you make? You make the gradient of this line. equivalent to an annual capital growth rate of 6.15% plus a 4% average dividend yield, that works about 10%. Isn't it better than your fixed deposit? Or your insurance? Just kidding. Now, how about Hong Kong? It's the same thing. In the short term, it go up and down. In the long term, it always go up, always make money. That's how they speak, right? In Hong Kong, I don't know. And over time, you make about 13+%, right? And this works in any market except Japan. Don't do this for Japan. Japan, 25 years go downtrend. Because Japan is not inflation, what? Japan is what? Deflationary. And Japanese is not an increasing birth rate, is what? Declining, and it's aging population. So the demographics are against them. So this doesn't work for Japan. Make sense? Okay. So based on what I just showed you, is there a way to confirm, guarantee, chop and sign, sure make money in the stock market? Yes or no? Yes. How? Yeah, just buying the index. Just buy the index. How do you know you can buy the index? Huh? Only about 25%. How do you know you can buy the index? Now you know. Lah. So now you know you can buy the index. Is this information valuable? That's why information is money. Information is what? Money. The rich get richer in Singapore not because they are luckier, not because they are smarter, because they do things differently from people who are not rich. They know how to make their money work for them. So how do you buy the index? You can't actually buy the index per se. You buy something that tracks the index. What's that called? It's called an ETF, right? So every index has an ETF that you can buy that tracks the index, right? So the first lesson to learn today is this. You can make a 10 to 13% annual return with little risk by buying the index and holding for the long term. Now, when I say long term, means really long term, 10, 15, 20 years. 20 years, okay. So how many of you believe in Singapore? You believe that over time, Singapore will be more and more successful over time. How many believe that? Even after Lee Kuan Yew died. Which we thought he did before National Day. Just kidding, but I love the man. But the point is this. What do you buy if you believe in Singapore? You buy the Straits Times Index ETF, right? How do you believe in China? Now there's a slowdown, of course. But who says over time China will be the world's biggest market? Who says? 中国. So you buy the what? Shanghai Index ETF or the Hang Seng Index ETF? How do you believe that Europe is now in a big mess, but over time they should sort it out and be better 5-10 years from now? So you buy the European Index ETF? So you get a point? Okay? So I know a lot of people say to me, but Adam, 10 to 13% not exciting, right? But better than fixed deposit, right? You get the point, right? Okay? Now let's move on to the next thing. How do you make a higher return than that? Can you make a 15%, even up to 20% return from the index in the short term? That means to say within not 30 years, but 3 years or even 3 months. Is that possible? Yeah. How? By not buying and closing your eyes, by knowing when to buy and knowing when to sell. So to do this, you must be more of an active investor. You have to buy when the market is on a what? Uptrend, and sell when the market goes on a what? Downtrend, right? So you be an active investor, learning how to time the market. So let me give you an example. This is the Straits Times Index from 2007 to 2012. And this was one of the worst 5-year periods in Singapore's market history. Why? Because you had the subprime mortgage crisis, yes or no? And you had the European debt crisis triggered by Greece, yes? So let's say you bought the index in 2007. You bought here. Close your eyes. And then you open your eyes after 4 years. Sorry, 5 years. Where are you? Broke even, right? So does the buy and hold method work? Yes or no? Yes or no? Yes, only for long term, which means at least 10, 15, 20, 30 years, then it works. Anything less than 10 years, buy and hold doesn't work. Because markets are extremely volatile. Now, if you buy at the wrong time and sell at the wrong time, during that period, you can end up breaking even or losing money. Does it make sense? So to make money in the short term, you have to read trends. Now, here's the thing. It is impossible to predict where stock prices go day by day. It's impossible. But if you study stock patterns, markets go through periods, or say periods. Periods of optimism and periods of pessimism. So during a period of optimism, the market goes through what we call an uptrend, or say uptrend. Pessimism, downtrend. Market can even go sideways. What's that called? consolidation, or the market is uncertain, a period of uncertainty, right? So here's the rule, listen up. You want to make money in the markets? You only buy on an uptrend. Let's repeat, only buy on an uptrend. So you only buy here uptrend. Okay? And you never buy on a downtrend. Because on a downtrend, you never know how low the market can go. Even if something seems cheap, but cheap can become even cheaper. Okay? So the idea is to buy only at the uptrend. You buy here, ride the uptrend. Go up, make money, make money, make money, make money. And when it reverses to a downtrend, you sell. So you sell here, let the whole thing come crashing down. So everyone die except you. Once you hit the bottom, let it reverse into a new uptrend. New uptrend, then buy. Go up, make money, make money, make money. Once you reverse downtrend, get out, sell, let the whole thing crash, everyone die except you. So in other words, you buy here, you sell there. You buy here, you sell there. If you do that, would you make a lot more money? Yes or no? So why do you do that? So why don't people do that? Because many amateurs who are not trained in technical analysis or fundamentals, they don't know how to read trends, yes or no? They don't know when the trend changes, right? So how many of you have experienced this before? Okay? Have you experienced this before? Sorry. How many of you have had this? Right, stock drops, pump, and you say, "Aya, drop to the bottom, now it's recovering, buy, see." Then it goes even lower, right? And you say, "Cannot go lower already, so low, so cheap, it cannot go lower," right? You start to recover, recover, buy, see again. Cannot go lower, like it's so low already. Recover, yeah, see. Then by that point of time, all your money, gone. And you're so frustrated, stupid market, mine is real. Don't play already. Then the moment you stop playing, go up. Have you experienced this before? Right, so don't buy here lah. What are these called? These are called what? There's a downtrend. These are called false breakouts, or they're called bear traps, right? They're to trap amateurs. You don't buy here. These are called rallies on the downtrend. You only buy here when the trend really changes. Now the question is there a way to tell when a trend really changes? Is there a way to tell? Yes or no? There's a way to tell. There are no guarantees, but there are ways to tell more accurately. Okay, would you like to learn how to tell? How do you think that if you can tell when a trend changes, you can make a lot more money than now? How do you think you can save a lot more money? So should I teach you? For free. Okay, I'm very generous today. I'll share with you the simplest technique which I teach my students. Right? I call this my kindergarten technique. Right? It's a very simple technique, but it will help you to get out of trouble. Right? And the technique you can use is the right moving average crossovers. And here's how it works. So let's say this is can you all see? No? You cannot see, just pretend you can see. Let's say this is a downtrend. How do you know it reverses into an uptrend? One way is for medium-term strategy. You use a 50 and 150-day moving average signal. You all know what moving averages are? You take the last 50 days of closing prices, add up, divide by 50. Keep plotting in a graph. Nowadays, the charting software does it for you automatically, right? Okay, here's the thing. Always remember, on a downtrend, the 150-day moving average is always above the 50-day moving average. Always. Always, okay? So, how to remember? Imagine this is a 150 kg man, fat man. 50 kg man, small man. When big men sit on small man, what happens? Go down. So when the 150 is above the 50, never buy, because it means it's going to go lower, right? And the two moving averages have to be sloping down. The slope makes a very big difference. So how do you know a downtrend reverses into an uptrend? First thing is the two moving averages must stop sloping down. So in other words, it must start to what? Reverse the slope. And the blue must cross above the green. So now, the 50 is above the what? 150. This is an uptrend signal, and that's when you go long. Understand what I'm saying? Follow? Now, the converse is true. Let's say on an uptrend right now, you're in a market. When do you get out? You get out when the trend changes, right? You don't want to get out prematurely here, right? So again, how do you know? On an uptrend, what is on top? 50 or 150? 50 is on top, right? So on an uptrend, the 50 blue line is always above the 150 green line. Small man on top, big man below. Big man carries small man go up. Simple? And both moving averages are what? Sloping up. A downtrend is signal when they both stop sloping up. So it starts to turn, and what happens? The blue crosses below the green. So now the big man is on top and the small man is below. All right? So how do you use it? You can use any charting software. You can use Chart Nexus, you can use Think or Swim, Options Express, CMC, whatever charting software. You key in the moving averages, 50, 150, and you can take a look at the trends. So now the 50, 150, is it clearer when the trend changes? Okay? So, when do you buy? You buy when the blue crosses the green, right? Can you see that? So that's when you buy. You buy here, goes up, and then here it drops. Now, do you sell here? No, because it's not a downtrend yet, because the blue is on top of the what? Green, which means it's still an uptrend. So you continue holding, right? Keep holding, keep holding, keep holding, keep holding, keep holding. When do you sell? When the blue crosses the green. That is the sell point. Okay, so you buy that, you sell that. And notice by selling that, you get out before the horrible death. Amateurs who do not know about this technique, would they buy here? Thinking it's a recovery, they buy pa-si. Well, buy pa-si again. Wait for the blue to cross the green, then you buy back here. So you buy back here, right the burger all the way up, all the way up, all the way up. Blue cross green. Do you sell there? Do you sell there? No, you don't. Why? Because the green is still sloping up. They must both stop sloping up. But let's say you cock eye, you cannot see the slope properly, and you go and sell. Never mind. If you reverse, buy it back again, right? And you continue making money. And now the blue crossed the green, and can you see that both of them are now sloping down? That's when you sell, get out before the horrible death. And if you simply use this kindergarten technique, you buy here, sell there. Buy here, sell there. 40% return, 39% return. What's your total? Too fast. What is your total return, everyone? What's your total return? 79% return. You make 79% return when everyone made 0. Isn't that good? You don't look excited. This applies to any market. Take a look at the Dow Jones. The Dow Jones from 2006 to 2011 was one of the worst periods because of, again, the financial crisis, right? You bought here, close your eyes. You got to constipate on the way down. Go up, open your eyes after so many years, break even, right? But if you use the Mickey Mouse technique, I just taught you kindergarten Mickey Mouse technique, put in the 50, 150, guess what? Now you can see, right? Blue cross, green, sell, let the thing crash, everyone die except you. Then buy back here for the run-up. Sell here, buy back here again. If you do that, you would have made how much? 72% return when everyone made 0. Okay? So how do you think that this technique can help you make money? Right? If you think this is powerful, this is nothing, man. What I teach in my workshops will blow your mind. All right? I mean, in reality, I don't use these 2 moving averages anymore. I use up to 5 crossovers. So I get in before anyone else, I get out before everyone else. And I combine with a lot of other techniques, fundamentals, Fibonacci, support resistance, so I can time my entry a lot better. Yeah? And like I said, I'm challenged because I normally talk for 4 to 5 hours. I only got half an hour, which means I only got 3 minutes left. Right? And what I've shared with you today is less than 0.001%. Right? If you want to learn a lot more, I've got an event coming up, which is a 3-hour, more in-depth, intensive investing workshop. Right? If you're interested in that, anyone interested in that? Okay, good. If you're interested in that, I can tell you a bit about it. Where is it? Yeah, because what I'll do during that workshop is I'll not just talk about the index. Because here's the thing, if you want to make a lot of returns, can you just buy the index? No, you have to buy individual what? Stocks of individual companies that will beat the index, as you know. So I'm going to teach you how to select individual companies, whether CapitaLand or Olam or what do you look at? What are the criteria to look at, right? So I over-prepared for this talk, but normally I don't have time to finish all these slides. But basically telling you that how do you achieve a more consistent profit in your investments? All right, this is a snapshot from my recent portfolio. My graduates from my program, they get a chance to see my portfolio live, right? It's on my website. You can log in with your password and can just take a look, all right? You can see how I follow these rules. And I can tell you that some of my students are doing even better than me right now, all right? So it's a skill that can be learned by anyone, all right? So I got a workshop coming out called How to Build a $1 Million Investment Portfolio. All right, it's a 3-hour workshop, 4th of September, Tuesday, 7 to 10 p.m. But normally I'll direct about 10:30 plus, even maybe 11, right? Because I take a lot of questions, right? So we're going to cover these things, right? Psychology of successful investors, how to start planning your financial freedom today, how anyone can become a millionaire with the right investment strategies, okay? The 10-step model to value momentum investing. How do you pick the right stocks that's going to break up, make you a lot of money, right? How to identify and capitalize on market trends. What are the best opportunities in 2012? Okay? And this 3-hour workshop is just $29. With this $29, you also get a copy of this book, which I wrote a couple of years back, Secrets of Self-Made Millionaires. Just to show off a bit, this book was ranked number 1 on the national bestsellers list for about 23 consecutive weeks in Singapore. Yeah? So $29, you get the workshop plus you get this book worth $30. So no-brainer, huh? Now, for the first 35 of you who register for this workshop, you can bring a friend for $1. And the $1 friend will also get a book. Which means your friend paid $1 to get a book somehow. Wow, damn good, right? But only for the first 35, right? So if you want to grab this opportunity, go outside there and you can go and sign up for this workshop, right? So with that, guys, I hope you learned something. You learned something? Yes. There's a lot of money to be made, so go make money. All right? I'll see you guys at the top. Thank you very much. Have a great afternoon. Thank you.